it's Liz, the Frugal Libertarian. I wanted to give you a short video discussing insurance, what it actually is, how it's supposed to function, and why the health insurance industry as we now know it in its current incarnation is actually broken, and how more of the same won't improve it. I wanted to talk about this because this is something that's being talked about a lot in the media, a lot in private circles, a lot on social media. So I wanted to kind of do an overview of it. The basic concept of insurance is pooling of risk. So basically what it originally was a community coming together and having a generalized fund that whenever somebody would have something go wrong, like say somebody got really sick, somebody had a fire and lost their home and their possessions, say somebody's crops failed, something like that that really negatively affected them, they could request money from the pool to cover their losses. And anybody who contributed could then ask for money from the fund because they had all pooled their risk together. Basically saying at some point one of us is going to have a tragedy happen, something catastrophic happen, so we need to be able to have the funds there to cover it so that that person isn't destroyed by it. But this was voluntary. Nobody had a gun to their head saying, hey, join this welfare society or else. It was basically, if you don't choose to pool your risk with other people, you keep your risk independent, meaning I'm not paying into this, so I'm keeping that money in my pocket. But in the event that something bad happens, I'm on my own, and I understand that, and I accept it. It has many different incarnations today. There is life insurance, property and tenants insurance, auto insurance, and then health insurance. There are little tiny ones too, but I really want to focus on the big ones so that we can get a better idea of what's going on. Life insurance exists so that in the event of your death, your family is compensated with the money to, at minimum, cover your final expenses. So they cover any health costs that may have spilled over after your death, things like hospitalization, treatments, accidents, things like that, any costs coming from those things. Then there's also, of course, your funeral expenses, any debts you had in your lifetime, that sort of thing. That's what life insurance is supposed to cover. And there are two different kinds of life insurance. There's term life, which is what me and my husband have. It is a larger sum in the end, but it has smaller monthly payments. However, you only can get it up to a certain point in your life, and then it's usually rescinded. Some companies that provide it will let you turn it into the other type, which is whole life insurance. Whole insurance is almost like a savings account. The monthly payments are higher, the end amount you get is smaller, but you keep paying until you hit that amount, and then you just sort of sit on it and wait to use it. Some insurance, life insurance, can be drawn on prior to death. However, there are penalties both from the company providing the insurance and from the government with taxes that come along with doing that, but both usually give you some kind of option. So like if you have a terminal illness and you want to use your life insurance now to go on trips with your family or to stop working and spend the last year of your life or months of your life with your family instead, they will let you do that, but you also are then waiving your rights upon death. So you're not expecting any more from them. And again, there are penalties usually that apply when you do things like that. Life insurance is not mandated. Nobody is pointing a gun to your head and saying you've got to get life insurance. But of course, the cost of funerals, the cost of medical care and other care, basically the cost of dying can be very high. So it's one of those things that it's good to have, but if you can't afford it, you just don't have it. Life insurance is one of the purest forms of insurance out there today still. It is completely voluntary, nobody's forcing you to get it, and it acts in a truly catastrophic nature. When you die, then the contracted amount of money is given to your family because you pooled your money together with all the other people buying life insurance, and the company that's giving you the insurance is taking everybody's money in and then paying out when people die. Auto insurance is a little bit more confusing because people love to throw out whenever you point out that government doesn't require you to get any other type of health insurance, so why should the Affordable Care Act force you to get health insurance? People will say, well, you're forced to get auto insurance, and that's actually not true. Auto insurance has two different types. There is what the government makes you purchase if you're going to register a vehicle and drive it on public roads, which is liability insurance. Liability insurance means that if I do something negligent, the insurance company will cover the damages that people get from my negligence. So basically, I do something bad, the insurance company is going to help me cover the cost of the damages that happen to the other person as the result of my negligence. That's what the government makes you buy because driving a vehicle is risky. You're very likely to hurt other people. It's one of actually the most risky things you can do all day is get into a car and go drive. They want to protect other people from you. It's not really protecting you from anyone else. It's protecting those people from you. You do the bad thing, they're protected from having their costs skyrocket because of your negligence. When you have, say, a brand new car or a car that has a loan on it, you have to get what's called comprehensive coverage, which also then includes covering the cost of the vehicle if your car is totaled. It'll sometimes include repair costs for things like windshields and windows. It'll sometimes include things like car rentals, along that line. The reason, now no government is saying you have to get that stuff, but the bank giving you the loan, the person lending you the money for the vehicle may say, hey, you've got to go get this insurance because in the event that you total this vehicle, I want my money that I would have gotten while you were paying off the vehicle and using it. That's why a lot of people say I have to get it. It's not the government forcing them to get it, it's the person giving them the money. Now, auto insurance is not mandatory for every single human being in the United States. It's only mandatory if you have a registered vehicle and you're driving it on public roads. Well, pretty much just if you have a registered vehicle, because it's assumed that if you register it, you're gonna drive it on a public road. And that is, again, only liability because they're protecting other people from you. It's not really the same as the current incarnation of health insurance. Property insurance is taken out by people who own property. So whether you own land, you own a house, you're taking out insurance usually to cover the cost of the building, cover anybody getting injured on your property, again, a form of liability insurance, cover the contents of your house. A tenant's insurance policy is purely the contents of the house because you don't own the structure, you don't own the property itself, you're not responsible for anything that happens to the structure or the property, so you just cover what you own. The government does not make you get this either. And again, it usually has to do with, do you have a mortgage? If you have a mortgage, the bank may require that you have either property insurance, which most of them require that, or they require that you get separate mortgage insurance, which covers if you default or if the property is destroyed, the mortgage insurance company will pay the value of the mortgage to the bank. But again, there is no government entity pointing a gun at your head and saying you've got to have a tenant's insurance policy. It's basically understood, again, you're either pooling your risk with other people and paying a monthly premium in exchange for the possibility of having to make a claim against the policy and get money to compensate you for your losses, or that you won't. But if you do and you didn't have the policy, you're on your own. The government doesn't make you get that policy. In fact, you don't even have to get property liability insurance. It's something that's a good thing to have. I think most homeowners would have it just in case, but it's actually technically not mandatory. It is voluntary. Currently, the only form of insurance that is mandatory in the United States to purchase privately from an insurance provider is health insurance. Health insurance in the United States originally started in World War II when companies had a pay freeze on them. They were told they could not pay employees more than a set amount of money because of the war effort. So what businesses started to do, trying to attract companies, was they offered them health insurance. Basically the idea that in the event you get sick, will cover your costs. And that was given as a benefit in addition to their regular pay. And again, it was done as a way to get around, I can't pay you more hourly, but I'll give you this benefit in addition to your pay, which is equal to amount of money. So it's a roundabout way of paying you more. Other benefits an employer can give are things like retirement benefits. There's other things like dental vision coverage. Some employers give you credits, like every amount of time you've worked, they give you credits towards getting more education out of college. Different employers have different ways of giving benefits beyond just pay that they do voluntarily because they want to attract better employees. And that's how health insurance started. But the monster, especially in the last 30 years or so, has warped and mutated into something not recognizable as its original incarnation. Insurance in its other incarnations exists purely to reimburse you when something catastrophic happens. So your house burns down and all the contents are destroyed. You're reimbursed for, if you own the structure, you're reimbursed for the structure. And if you're a tenant or you own the structure, you're reimbursed for the contents, depending on what kind of plan you have. Car insurance, you know, if you have collision and you get into an accident and your car is totaled, they give you the price of the value of your car, not the price of the car, that's a different item, but they'll give you the value of your car because you lost it. It was totaled. It was a total loss. Life insurance, you die, your family is given money to pay your expenses and to take care of them. That's all catastrophic needs. And there still is catastrophic health insurance, but because it was not considered Affordable Care Act compliant, it has largely been done away with. Catastrophic health insurance was the same as these other kinds of insurances. You paid a very low monthly fee. You weren't given money to go and spend at the doctor every month, but the understanding was if you developed something like cancer, you needed to go in for surgery, you got into an accident and had to go to the ER, the catastrophic plan would then kick in and cover you. That is one of the most purest forms of health insurance. It's pooling everybody's risk and saying, if something horrible happens to you, we'll cover it. Now, the reason it has largely been done away with is that health insurance, like I said, in the last 30-ish years, has morphed into this monster where they're paying everything for you. It's no longer a pooling of risk. It's no longer you saying, hey, I'll give you $50 a month, and if I get into a car accident, you take care of my medical bills, okay? And then they say, oh, okay. Because to them, the odds of you getting into a car accident are small, so therefore they're willing to take your $50, and in the event that you do, then they will pay for it. Instead, we want health insurance to provide every single facet of care, from doctor's visits to, in some cases, Band-Aids and over-the-counter Tylenol. It is morphed into this monster where there is a company overseeing and paying the bulk of every single teeny tiny medical payment that could possibly be made to providers. This has not made health insurance a better thing. It's actually ruined the healthcare market as it stands in the United States. That is because health insurance does not pay the bill your doctor submits to them. They renegotiate with your doctor, basically saying, look, we know you want $200, we're going to give you $90. Here's your check for $90. And your doctor takes it because they have signed an agreement with the insurance company saying, I will accept this much of my bill in exchange for being able to treat your patients. So they've entered into a contract on their own with your insurance company, and that's why. But they're always sending, providers always bill at this higher umbrella amount because they know that the insurance company is going to come back and go, we're not paying that, we're paying this. In order to get this, if they would ask for this, the insurance company would give them that. Nothing. So they have to ask for the giant amount because if they don't, they'll get nothing. Now, the reason this has ruined the healthcare market in the United States is that if you do not have an insurance company to negotiate for you, you are going to end up paying this bill. Not this one, this one. The only instances I know of where doctors will negotiate your bill down is if you are standing there cash in hand at the time of service and they're never even going to have to submit a claim to an insurance company. If you are paying cash right then and there. And they're doing that because that actually saves them a lot of money. They don't have to pay for their billing person to do any work. They don't have to sit and wait for their payment from the insurance to come in. So they're willing to knock the amount of money they're due down to that level because they're getting it right now and they don't have to wait. However, if you do not have insurance and you cannot pay cash right then and there, you're going to get stuck paying that amount. And that is why insurance has actually ruined the healthcare market in the United States. Right now, the solution is a combination of more government and more insurance. The idea is, well, everybody needs somebody negotiating for them to get the lower costs. The problem is, again, they've eliminated your ability to have catastrophic care. Catastrophic insurance policies were extremely inexpensive because, again, they only paid in the event of something absolutely catastrophically horrible happening. If they're expected to pay for every little tiny little incidental thing that comes with your health care, the insurance company is going to want a larger amount of money every month. See, that's like asking you to have an auto insurance policy that covers oil changes, gas fill-ups, putting wiper fluid into your car, things like that. And I'm sure there are auto policies out there that are like that. I'm also equally sure those are really, really freaking expensive. You can't really go forward with what we have. Things need to change. Realistically, Americans do not need and are not better off with more health insurance. We're actually better off with less. We're better off with catastrophic care and then paying cash to your everyday needs providers. That keeps the costs to the provider down. They get paid immediately, they don't have to wait for payment, and that keeps your insurance premiums down. Unfortunately, our government doesn't let you do that as of right now. If you have any questions or anything I said wasn't really that clear, please leave it in the comments, or you can send me an email. My email is always in the description under the video. Thank you so much for watching. I really appreciate it, and I will talk to you soon with more videos. Bye.